Good morning. Thank you for joining us for today's presentation, Life Happens, Are You Prepared? With insurance expert Ellen Davis, president of Life Health Home Insurance Group, and real estate expert Jan Brito with Capital Senior Solutions. This presentation aims to untangle the intricacies of long-term care insurance while providing valuable insights to help you make informed decisions and secure your future with confidence. My name's Angelique Jackson, and I'm the Manager of Business Development and Marketing at Charles E. Smith Life Communities. We are a Jewish faith-based nonprofit organization who takes pride in providing personalized care and experiences tailored to the unique needs of older adults. No matter what stage of life they're in, we offer a variety of services, including independent living at Ring House, affordable independent living at Revit's House, assisted living and memory care at Landau House and Cohen Rosen House, post-acute and long-term care at Hebrew Home of Greater Washington, primary care at Hirsch Health Center, and Elder Safe Center, the first program of its kind in the Washington, D.C. metropolitan area to provide community education, advocacy, and safe temporary shelter to older adults experiencing abuse. If you're interested in learning more about our residences and services, please visit our website or give us a call at the Welcome Center to schedule a tour. Our contact information is shared in the chat. And I just want to share a few reminders before I turn this over to Ellen and Jan. We want to hear from you, so please make sure to add your questions to the chat. And we are also recording this presentation, so please make sure that you are muted as a courtesy to the other attendees. And I will make sure that everybody who attends this presentation will receive a copy of the video so you can review. So without further ado, I'd like to welcome our guests, Ellen Davis and Jan Brito.
Good morning,
Morning.
everyone. You're probably wondering, what the heck does insurance have to do with real estate? Well, I am here because this is my second year of partnering with Angelique and Ringhouse on presenting seminars on topics of interest to older adults. Again, what does that have to do with real estate? Okay, so as Angelique mentioned, I am Jan Brito with Capital Senior Solutions. I am a residential realtor who specializes in working with older adults through late in life move transitions. And my focus is on education and advocacy for older adults, hence these seminars. I often host seminars of various topics of interest to older adults. And insurance is a topic we all have to think about at some point. I also have a monthly senior downsizers club that is free to folks who are maybe having a little trouble figuring out what their next move is. It's a small support group, and we meet once a month on Zoom, and you can find registration links for those monthly meetings at capitalseniorsolutions.com, as well as a schedule of upcoming seminars. So without further ado, I would like to turn it over to someone I refer to as the insurance whisperer, Ellen Davis. Take it away, Ellen.
Jan, thank you so much. Angelique, thank you so much. It is, as always, my pleasure to work with both of you. I have worked with Charles E. Smith Life Communities. I think we were discussing about 15, 16 years, and Jan and I have known each other many years at this point. So learning about this particular piece of insurance is very important. I think it's very important because a lot of people don't actually understand what long-term care is and how it works and how it helps. So that's what we're going to talk about today. And we are going to demystify it. So let's get started. We're going to talk about what long-term care is. Now, I know everybody can read this. Some people may be on the call who may be visually impaired. So please bear with me as I read what is up here. So that everybody has the opportunity to understand what's happening. So long-term care insurance, or LTCI or LTC, as you know, we're in the DC area, we have to live with acronyms. It is an insurance product that helps pay for the costs associated with long-term care. Individuals who require extended care. And we're going to talk about why I call it extended care. May not be sick in the traditional sense, but are unable to perform 2 of the 6 activities of daily living, ADLs. Now, this is a key point. There are 2 points, actually. One, extended care. Insurance has to name a product, so they've named it long-term care. In my view, it's extended care. The other thing is, how do you figure out what the activities of daily living are? There are 6 of them. I have been in many rooms, anywhere from 10 people to 100 people. I can ask the same question. What are the 6 ADLs? And some people can pull out 2 to 4, never all 6, and never in any order. So we're going to talk about order, and we're going to learn how to understand what ADLs are in a very, and I guess ABC 1, 2, 3 kind of way. So let's talk about that. So the first thing that we do in the morning is we get up, we ambulate, we sit up, we sit at the edge of the bed, or as you can see, we might get pulled out of bed. But we stand up, we transfer, we start to walk, or we sit. That's ambulation. So A, ambulation, or the very first thing we do, we open our eyes, we sit up, okay? That's the first thing. The next is going to the bathroom, B. So that's the second thing. So the first thing, we sit up, ambulation. The second thing we do, generally we go to the bathroom. Now, I will tell you, the picture that is here, this is actually a statue in London, and in this statue's hand is a book, or part of the statue, which is called the BMO book, which has been published every year since 1939. So just a fact. The third thing that we do is we clean ourselves, or C. We brush our teeth, we wash our face, we take a shower, comb our hair. So far we have 1, 2, 3. We have ABC, ambulation, bathing, cleaning. First, second, third thing that we generally do. So after we're nice and clean, what do? We put on our fancy clothes, we get dressed. D. Fabulous. Okay, so I mean, this is as simple as I can make it. Now, the best part of these ADLs is, I guess my favorite is the 5th one, which is eating. Because usually after you've gotten up, you've ambulated, you've gone to the bathroom, B, you've cleaned yourself, C, you've now gotten dressed, D, I don't know about anybody else, but I'm generally kind of hungry. So then we eat, or the 5th thing. And the last, though it's not directly in order of this, it is something that we have to do each and every day, throughout the day and throughout the night. We have to feel in control of our bladder and bowel functions. So though it's not directly after E, or the 5th one, it is something that we do all day long and all night. And that is the 6th ADL. So very quickly, I'm sorry, it just makes me laugh. You're laughing so hard, I'm gonna pee. And this is what happens. So you have A, ambulation, 1, B, bathing, 2, C, cleaning, 3, D, dressing, 4, E, eating, 5, and F, feeling in control of your bladder and bowel, 6. So those are your 6 ADLs. One of the easiest ways I think people can remember. And in order for a long-term care policy to take effect, is somebody has to not be able to do 2 of those 6. And it's not just, oh, I've decided I can't do. These are things that a doctor has to know and list, and there are forms and documents that have to be done. So now, let's talk about extended care. Why are we planning for it? Well, I'll tell you why. It allows you to stay in your home or wherever you want to be. Is it an assisted living facility? Is it your children's house? It could be anywhere. The other is it allows you to maintain your independence and dignity. And a lot of people fight this. They say, well, I want to stay in my own house and I'm going to use all of the savings that I have accrued. And yes, that does happen. But having help to allow you to live a more independent life is not a weakness, it is a strength, because it does allow you, having somebody come in, be it family member or a professional, allows you to live a better, more secure life. Now, we will talk about how extended care protects your retirement assets and income, because this is one of the reasons why people look for extended care insurance. And the other, this one is the one that most people actually don't talk about, because your family members or your caregivers are the ones that carry a huge weight of the caretaking, the financial and emotional pressures that are put on by caring for someone. And we will talk about that as well. So let's talk about the two different types of, I guess, as I said, on this screen, impairments to consider. So acute, something that happens very quickly. We also might look at something that's acute, that after X number of days in a hospital, you might need rehabilitation care, medical or rehab. It could be cardiac rehabilitation. It could be physical rehabilitation. But there is a general expectation of a degree of recovery. So that is what acute is. It's quick, it's fast, and we believe that it will turn around within short order. And short order, by the way, I shouldn't have jumped ahead, but short order, by the way, could be a few weeks, it could be a month, it also could be a year. So acute isn't 24 hours, but acute is not chronic. And chronic is a little different. It's how we manage something that is long-term, that will continue past a week, past a month, past a year. And then we talk about the different types of chronic. One is physical. So that, if you notice, shows compromised functions measured by your ADLs. So remember, we have those 6 ADLs. 2 of the 6 are what start the process. But some people can't even do all 6. Some can only do 4 or 3. Then we have hands-on, somebody who really needs to step in and help somebody dress, help somebody bathe, help somebody go to the bathroom, help somebody eat. The biggest chronic issue that we have seen over the last several decades is cognitive. This is dementia. This is Alzheimer's. This requires a higher level of supervision, and that is a long-term chronic condition. So these are both acute and chronic. This is where extended care really comes in for both of these issues. So we have myths. I love myths. So here's your first one. The government programs will pay for long-term care. That's a myth. Let me tell you why. Very quickly going to touch on Medicare. Now, I want to talk about this screen carefully. The very first line of the screen is skilled nursing facility care is paid if preceded by 3 nights admitted, not observed, in a hospital. This is a key piece. I tell all of my clients who come into Medicare, if there is a major issue, you must be admitted, not observed. Because if you need any type of rehabilitation in a skilled nursing facility, like Charles E. Smith Life Communities, in order for Medicare to help defray the cost, you must have been admitted for 3 nights. So let's talk about what that actually means. Financial assistance. If you notice, days 1 to 20, Medicare will pay 100% for approved hospital and skilled nursing costs after 3 nights admitted into a hospital. So if you're in the hospital for 5 nights, guess what? Then you go to a facility, Medicare will only pay for 15 days in that facility because it's a full 20 days from the moment you are admitted. Okay, so it's not 20 days after I've been released from the hospital. So please be aware of that. The second thing is, let's look at days 21 to 100. So Medicare will pay the costs above the daily copay. And in 2024, the daily copay is $204 a day. So let's talk about what 21 to 100 days, which is 79 days, will cost out of pocket a total of $16,116. And yes, I can do the math that quickly. Not for everything, but at least for this. So be aware, the first 100 days of care, Medicare will help defray the costs. Your responsibility will be $16,116. Now, what happens after that 100th day? All of the costs are on you. Medicare is done. They will pay the doctor if you need doctors, but they will not pay for skilled care. So this is a very important myth that needs to be better understood, because government will not pay for your long-term care for the long haul. For a short term, in a very specific way, it will help defer the cost, but it will not pay for everything. Now, let's talk about the annual cost of care. So the screen that's up here now, if you notice, it is the cost for 2021. We are in 2024. And the reason why I'm using 2021 is we were just coming out of COVID. Prices had increased tremendously. These numbers that you see here are an average across the United States. And we're going to talk about this. Now, unfortunately, I cannot switch to the live screen that I have on another monitor, which will give me actual daily numbers for different locations in the country. So if you give me one moment, I am going to pull up the state of Maryland, because that's where Charles E. Smith is located. And that's where many other facilities are located. And we're going to talk about the types of care that we see here and how the average for the United States works against different states in the United States individually. So if we take Maryland, DC, we are looking at home care. So where it says home health aid at 61,776 on here, this is 2021. In 2024 in Maryland, DC, it's approximately $69,057, so 69057. Assisted living across the United States, the average is $54,000. I want that so badly. My mother-in-law is in assisted living. I want to pay $54,000 a year, but we're not going to. So the average in the Maryland, DC area is a little over 80,000. And for nursing home facility, as you can see, the difference between a semi-private and a private, you're looking at approximately 139,000. Now remember, these are averages for the entire state of Maryland. So you have some rural areas, you have Montgomery County, you have Howard County, you have PG County that are not rural, so the costs are higher. If we take a look at, a lot of people move out of Maryland when they retire, so let's jump down to Florida and let's talk about the averages there. So home care is about $64,000, assisted living about $57,000, and nursing home about $119,000. So a little less, but again, we're talking about a state average. Now, without going through the entire country, anybody have a guess which state is the least expensive? Angelique, tell me if anybody says anything.
Will do.
Delaware?
It's a good,
Arizona.
also good. Interestingly enough, let's talk about Arizona real quick. You'd be surprised. So Arizona, home care is $76,000, assisted
Oh,
living $64,000, and nursing home $92,000. It was a good guess, but no. So as
we've got
children, I'm sorry, where else?
we've got a few. We've got West Virginia. We've got
Okay.
Mid-East somewhere like Kansas or Nebraska. We have Minnesota and we have South Dakota.
Oh, all great choices. Unfortunately, none of them come close. So as children, do we all remember how you used to spell Mississippi with one I? Mississippi. And the state of Mississippi is actually the entire state. Again, state average is the least expensive for care, long-term or extended care. So home care, $49,000. Assisted living, $50,000. Nursing home, $96,000. But do you hear these numbers? I want you to hear the numbers. This is the least expensive state average across the United States, and in the state of Mississippi, that is the least. Anybody have a guess as to which one is the most expensive?
California.
Keep trying. Anybody else?
Maryland.
Florida.
New
Nope.
York?
New York, somebody, two people said New York in the chat.
Nope. The most expensive is Alaska.
What?
Oh my, I can imagine.
So home care is 77,000, assisted living 92, and nursing home $344,000 a year in Alaska. Nursing home 344,000. That is more than double where we are in Maryland. Okay, so don't go to a nursing home in the state of Alaska.
Yeah.
Okay. All right, let's continue. So we're
Ellen,
going to talk about some, I'm sorry?
There's a question in the chat.
Okay.
Can you talk about what kind of supplemental plans may pick up costs of what Medicare doesn't cover for inpatient stays?
Oh, absolutely. And we're going to get to that.
Oh, good.
Okay. So that's what extended care and long-term care is. So let's talk about our next myth. I do hear this a lot, by the way. So I've got money. I've got assets. I've saved. Now, you've just heard some of these numbers. Those are annualized numbers. So I'm going to still use the concept of both the United States average of whatever we choose to use when I'm using when I talk about calculations, and I'll also use something that's a real life situation. So I will self-pay against long-term care. Let's talk about how that works. Now, I want you to notice I have a little one here. So at the bottom, I am assuming a 4% annual return on assets. Just very basic, easy numbers. All right. If you have $1 million and you get a 4% return annually, you will make an income of $40,000 annually. And of course, we go up from there. 1.5, 2 million, 3 million. So we're going to use the 3 million as the example. If you have 3 million in the bank or in some investment or whatever, and I'm not calculating what you have to pay for capital gains or anything else, and you have a 4% return, you will have $120,000 of annualized income. Now, if you have on average, and let me pull up Maryland one more time so I have it in front of me. If you have home care in the state of Maryland, just the care, just the person or the people, that come in to care for you. You are spending $70,000 approximately, this is state average, for that care in home. That is just for the person. It does not cover taxes, insurance, food, cable, hairdressing, clothing. Doesn't include anything else but the care that you are receiving. So if you have $1 million and you have to spend $70,000 a year, but your income is only $40,000. And again, I am not taking into account Social Security. I'm not doing any of that. I'm just talking on a very base level. So I want you to think about how this works. You have to pay for care. You have to pay for your food. You have to pay for your housing. So how does that all happen? We've all worked so hard to accumulate our retirement income, our Social Security, our investment income. Well, how does that work? So I want you to kind of have an idea. Again, this is 4%. Some years we get a 12% return, and some years we're at the bottom of 24% under. So I want you to just keep a very basic number in your head as we move through this. Okay, so what is insurance? So, I've been doing this a very long time, 39 years actually. I'm only 29, so really don't think I'm any older than that, please. I did not wake up one day and say, ooh, I'm going to be an insurance broker for my life. But I will tell you, over the years, I stand on certain soapboxes. One of them is that insurance is better than sliced bread. And the reason why is that you actually transfer financial risk at some level for pennies on the dollar. And I am not discounting the fact that pennies might be hundreds or thousands of dollars or tens of thousands of dollars. But the difference being is if you have $1 million in the bank and you have a 4% return, or even if you have a 10% return on that, a 10% return on $1 million is $100,000 a year. And you look at care costs, be it when you're 80, 60, 30, somewhere or another, the cost has to be paid. So the idea of extended care or long-term care is leveraging the risk and transferring the risk for a certain amount of dollars. And that's what you're doing. Oops. So this is what happens. So all of that money that you have saved, that you have worked for, that you have invested. And that's okay if that's what you choose. If you choose to say, I'm going to pay for my care from everything that I have, the equity in my house, my retirement income, my assets, whatever my family can sell for me, okay. But if you want to preserve some of it or allow it to last longer, then you transfer some of that risk and you look at some level of a long-term care or extended care plan. And please know, I am not talking about putting anything in place that pays for everything. That becomes somewhat cost prohibitive. It's about allowing your assets to last longer. So long-term care is not set to pay the entirety of the bill. But to pay the bulk of the bill, that would be very important. So let's talk about the different types of long-term care policies. And there are two main types of long-term care. There's traditional long-term care. So, and as you can read here, it works very similar to an auto or a home insurance policy. You have a premium to pay, either annually or monthly, however you've worked it out. And when the need arises where you cannot do a minimum of 2 of the 6 ADLs, A, B, C, D, E, F, or 1, 2, 3, 4, 5, 6, you then place a claim. A lot of people who have traditional policies, they might have something called a waiting period. I'm just going to talk about an average here of 90 days. which means that when you place a claim and it's approved, there is a 90-day waiting period before your long-term care policy will pay a claim, which means you have to have enough money in the bank to pay for the first 90 days. And if we use the average of the state of Maryland for assisted living, which the average was a little over $80,000 for the year, those first 3 months, you have to be able to support that. Okay, that's what that means. But then long-term care jumps in, and whatever your daily or monthly rate is, that then defers that cost for you. And as you can see, it tells you how much you get per day, how much is paid per month, how much is in the pot of money that is used, and how long it will pay for. And here's another tiny little myth. People might have a policy that says, oh, I have a 5-year benefit period. Does that mean that my policy will end at the end of 5 years? Some old ones, yes. Some newer ones, what happens is the pot of money that's in there that, depending on how you've worked it, may grow, which means that if you're not using the maximum amount per day or per month, the money in the pot will last longer than the term or that payment period. So yes, then the policy will continue to pay until the funds are emptied. Some policies, some older policies, are very clear cut. Most of the newer ones, several, a decade plus, have an adjustment to that. So it depends on your individual policy. And we're not going to talk about individual policies. Okay, we're not going to talk about carriers. Now we're going to talk about what are hybrids. And hybrids are a really cool thing, actually. They have not been around as long as traditional. But what's really nice about them is that in a traditional policy, if you don't use it and you've paid in your premiums, that's it. You've just like your home or auto insurance. You pay it, you use it, great. You don't use it, well, you've paid your premiums and you have had assurance in your insurance. When it comes to a hybrid, it utilizes a different vehicle, either a life insurance policy or an annuity to help create the policy. And with that comes some additional benefits. And some of those benefits create the situation of, if you don't use the policy, there is a death benefit for your family. Some policies allow you to later on surrender them and get some, not all, but some of the money that you've paid into them back. So that's a different way to look at it. They're extremely popular and have become more and more popular throughout the years because it gives greater flexibility and gives another sense of, I'm not just paying something and I'm not going to use it per se. If I don't use it, I'll have something back, or my family will have something back. I love the peanuts. So we're going to talk about some tax benefits of long-term care very briefly, because I want you to remember, I'm going to put all of these up, is that I am not an accountant. So it would be extremely important for you to speak to your accountant to determine if you have any tax benefit from having a long-term care policy. If you look at the second one, you can actually gift an IRA, an existing IRA that you may or may not need, to an adult child or to a grandchild to fund a long-term care. How does that work? Well, let's say you have an IRA with, I'll use round numbers, just make-believe numbers, $100,000 in it, and you have calculated that you're not going to actually need that to live on. You can gift that to your child for a single premium payment for a long-term care policy, either a traditional or a hybrid, to fully fund it or to partially fund it. It's actually kind of a neat program, and it does have a lot of tax benefits. But again, very important, I am not an accountant. please talk to your accountant. All right. Everybody likes statistics. I'm going to give you some statistics, okay? These are real 2023 numbers. So I'm going to let this sit just for a moment because it is the first percentage of 66% of caregivers that use their own retirement and savings fund to pay for the care for their family member. So does anybody have a teacher in their family and they hear and they see that the teachers are using their own money to bring in supplies for their kids? Well, this takes it to a next level. So 66% of caregivers, family caregivers primarily, but family for caregivers, they will use their own savings, their own retirement to care for their family member, be it a sibling, a child, or a parent. So imagine their pool of money becoming smaller and smaller. 7 out of 10 people over the age of 65 will need some level of extended care. And remember, extended care could be acute, short, with a degree of healing, or chronic. 7 of 10. Angelique, I have no idea how many people are on, but if there are 10 people, 7 of us at some point will need some level of care, be it home care, home aid, family aid, assisted living, long-term care. And of course, everybody is affected.
Yeah, we have 29 people. So
Okay. All right. Now, these are actual quotes. Please take a moment. And then again, allow me to read them for people who may be visually impaired. In theory, oops, what happened to my cursor? There we go. In theory, I believed I could take care of my mom and dad. I'm Superwoman. I can keep up with my work, take care of my family, my kids. But in reality, I was constantly torn, feeling guilty that I'm not doing enough for anyone, including taking care of myself. The next one, my children were resentful that I have a sibling who did not help me. Or the other, anger at my brother for not helping more with our parents, stress with my wife over how much of our time, our family time, their care, parents' care, by the way, was taking up. And if I can ask, you don't need to raise hands. This is rhetorical. Have you yourselves or somebody you know within your family or in your friend base caring for a child, a sibling, or an adult? Have you ever heard anything that is similar to this? Just take a moment. These are actual. And this is what happens no matter how you look at it. When you provide care, if you do not take care of yourself, you yourself can become chronically ill. Almost 100% of the time. And again, I would ask you to think of the people around you, people that you know, that or your family or yourself. You might be in this exact situation. And we talk about the sandwich generation. And I joke, people think a sandwich generation is a Dagwood sandwich. It's a big sandwich, with lots of stuff in it. It's big. So the parents are at the top and you're in the middle and the kids are at the bottom. Unfortunately, the sandwich generation is actually those garbage 100-calorie Oreo cookies that have absolutely no cream in the middle because those little tiny cookies are smushing it down so much. That's really what the sandwich generation is. You feel the push, the pull, and the pressure. And from that, the stress gets created. And from that, when you don't take care of yourself and you don't, in order for you to take care of others, you will become chronically ill. In one way or another, it may be physical, it may be emotional, it may be your immune system, it may be anything. So just please be aware of that. Oh, this one's a doozy. Loving this one. That one's a little hard for me to take right now. Because by 2030, every baby boomer will be 65 years or older, that generation, and I'm the last of them. So remember we said 7 out of 10 people. These are the same exact numbers. But look at these. You don't generally think of somebody who is young that will need care. But we have seen it, and we have heard about it. There is a unfortunate solid percentage of younger people, I'm young, but younger than I am, that will need some level of care. And I want to thank you. This has been a lot of fun. I know there are questions, and I want to make sure that we have time for those. How's that?
Okay, sounds good. Well, then I might as well get to, so we have 2 so far, so
Okay.
please, everyone, if you have any more questions, add them to the chat. But Jan asked the first one, I think we've already went over it. Can you talk about what kind of supplemental plans may pick up costs of what Medicare doesn't cover for inpatient stays? So,
Okay, so let's briefly touch on that actually. So, and I can't get into the depth of Medicare or Medicare supplement because that is not what this program is about. But I do want you to know when somebody who is 65 years or older and they have Medicare Part A and Part B, if they have a supplement and a prescription plan, then those plans will help with the cost of doctors and prescriptions, not for care. Okay, so I want to make that really clear. A and B, A is hospital, B is doctor, will pick up approximately 80% of the cost for a doctor and or a hospital. Your supplement behind it will pick up the other 20% depending on the type of supplement you have, and the prescription covers the prescription. It is only when somebody is admitted, again, we say the word admitted, for a 3-night minimum stay in a hospital and then has to go to some skilled facility for rehab or other type of care, will Medicare pick up the cost for full cost for up to 20 days, and 21 to 100 days, there is a copay, a daily copay. As we said, in 2024 is $204. And of course, in 2025, though I don't have the numbers and I cannot share them even if I did, because this is not a Medicare program, that copay will go up. Other than that, it is everything that you have saved, everything that you have invested. If you do not have a type of policy that will give extended care, a long-term care policy, is one of those types of plans that help offset the total cost of care. Now, I did talk about the fact that I joked that I really wanted that $54,000 assisted living facility cost, which is the average across the United States. And I will share with you, my mother-in-law is in an assisted living facility, and both of my parents are gone. And thankfully and luckily, they actually spent my mother her last 6.5 years, and my dad 9.5 years at Hebrew Home, both in the nursing home. They were together until my mom passed, and then my father lived for a few more years. So I know Hebrew Home very, very deeply and very closely. But my mother-in-law is not at Hebrew Home. She is at another facility, and her monthly cost for assisted living, her apartment, 3 meals, and the care to get her bathed, dressed, bathroomed, ambulation, and cutting her food. Okay, so I want you to be aware. One thing she can still do is she can still control her bladder and bowel most of the time. Okay, so she's 4.5 of her ADLs. She is visually impaired, the beginnings of dementia, and monthly is $13,000. That does not cover the cost of her Medicare, her supplement, her medications, her haircuts, her dental, her clothing, her outside food, or any other things. A cup of ice cream is not covered in that if she wants a treat. So and this is in the Montgomery County area as well. So $13,000 a month. That's not $54,000 a year. It is actually $156,000 a year. And that is the cost just for her assisted living. So please, Angelique, next question.
Thank you. Great question. Thank you. And then someone asked and I'm pretty sure that it was pertaining to when you were speaking about the hybrid policies. Is there a significant upfront payment?
Oh, good question. Actually, for both types of policies, you can create. This is where I love this. This is part of the creativity. You can create something called a single pay, so a one-time payment, and then you're done, which actually locks in the cost because you don't pay another premium. You can do something that is an annualized premium that you pay for as long as the policy is in place. You can do what's called a 10 pay. You can create a situation where you can extend the payments for 10 years, and at the end of 10 years, you are done paying that premium, or a 7 pay. You can play a lot of different ways. Some examples of that, and I'll give you my own. So I have had my personal long-term care policy for just short of 20 years. So I'm 60 years old. I will share that. I got it right after I turned 40. A lot of people go, oh, 40. I thought you were supposed to be 60 or 70 when you get them. And I believe when you're 40 and 50 is when you get them. You're healthier. The premiums are a lot less. Anyway, so my policy, when I wrote it, we did not have hybrids. And I have a traditional long-term care policy, and I pay a premium annually. For a long period of time, that premium did not change much, and COVID created a different world for insurance carriers. They put out billions of dollars in claims, and somehow or another, they have to backfill those losses by increasing premiums. So it's not, oh, I'm gonna, an insurance carrier says, oh, I'm gonna increase a premium, let's go get them. No, there's a whole process. They have to go through. They have to, go through the insurance commissioner of that state. They have to go to their board. There are a lot of different things. So it's not an immediate thing. But in the last 3 years, my premiums have increased. I will tell you, it does not matter to me what my premiums increase to. And I know that's somewhat cavalier because, of course, it does matter. But I will not stop paying my long-term care. I won't. I've seen it in action. Both of my parents were in nursing homes. My mother was on her long-term care policy in home health for 7 years before she was in a nursing home with full-time care. Her long-term care policy, because she had a pretty decent insurance broker, lasted not only the 7 years of home care, which started part-time. It was 3 days a week, about 4 hours a day, to eventual 7 days a week, 8 to 10 hours a day. Before it became full-time. And once it became full-time in a nursing home, it lasted 3.5 years, almost 4 years of her 6.5 years of being there. So that helped defray the cost. That was great. My mother-in-law has now been on her long-term care policy. She also has a traditional, and I'm going to get into hybrids in a moment. And the premiums, for a year, so this is her second year on her policy. She had home care, part-time, 5 days a week, 4 hours a day. My father-in-law passed away last year. And so she needed greater help. And so we needed to move her at that point into assisted living. So now she uses the maximum monthly benefit, which does not pay the whole $13,000, but it does help pay a good amount of that so that she's not utilizing all of her assets that she and my father-in-law accrued over their lifetime. Now, for hybrids, you can do the same exact thing. You can have an annual premium, and with traditional, you can have an annual premium like mine, where I will pay my premium until I either use it, where then I no longer have to pay the premium, or I have canceled it, which I will never do, or I've passed away and I've never used it. And so I will always pay my premium. That is a lifetime premium. I have clients that do what's called a single pay. They take a large amount up front and prepay the whole thing. That is one of the really cool things about the potential tax benefit of utilizing what's called qualified funds. So qualified funds are those that you put into a retirement vehicle. So you defer the taxes that you pay on the growth. That's what makes them qualified. So your 401k, IRAs, 403bs, those are all qualified accounts. You're putting money in there, you're not pulling it out, because if you do, you have a tax consequence. And if you pull it out too early, you also have a penalty. So you're deferring the tax on that. Whereas your bank account that maybe is getting, I don't know, 3 or 4%, maybe 5%, depending on if you found one that has that, that you are paying your income, you're paying taxes on the growth of that money. Okay? So you can utilize a qualified account to prepay either your own long-term care policy, either a hybrid or a long-term care, where you can gift that money to a child or grandchild for their prepayment. You can also create a situation, as I said earlier, you can take X dollars. Again, I'm just going to pick a round number. Let's call it $10,000 a year for 10 years. They're made up numbers. Please, I have no idea what yours would look like, but you would pay $10,000 a year for 10 years. And at the end of those 10 years, there's no other premium. And what you've created continues. Does that help? Angelique, any
I
others?
hope so. Yes, we have more. So the next question, is there a specific policy that doesn't require health qualifications even at 78?
Oh, great question. So the hybrids, there is always going to be some type of health question. You can't, unfortunately, there are certain illnesses that if you currently have them, you will not be approved. But on the hybrid side, there are certain types of policies that you can get with less medical information because you're utilizing a different vehicle, let's say an annuity that is created with a long-term care rider. There are still some medical questions, but they are very different than a full traditional or a life insurance policy with a long-term care rider. That's what a hybrid is. So the hybrid is the long-term care piece of it is the rider to either the life policy or the annuity. On the annuity side, there are less questions. Still questions though. So it would depend on your specific situation before I would tell you to move forward or not with something. What's next?
Okay, thanks. So then the next question, so we have about 1, 2, 3, 4.
All
This
right, I'll
one
try.
comes-
I'll try not to talk too much.
Okay, so tell us about the application process for long-term care and who is best to help you apply for these plans and who understands the process. Do you recommend using a certified financial planner? And do you charge to help people apply for long-term care?
Okay. Hopefully those are multiple questions all pushed
Yes.
into one. Okay, great. Okay. So who is the best person to help you? Well, interestingly enough, there are people that are certified long-term care people like I am. I'm a certified long-term care insurance broker. Somebody who specializes in long-term care, who really knows the ins and outs. Certified financial planners, they're fantastic. I work with a lot of them. If they understand long-term care and they focus on it as opposed to handing you off to somebody else, then yes, they're a perfect person. Even though they might be managing your money, they need to know the ins and outs of how it works so that it works within your plan. And that's one of the other things. Let's talk about that. And that's kind of where Jan jumps in here too, a little bit. So when you're working on a plan, on a life plan, you're looking not just for today, you're looking, big picture. How do I get from A to Z without losing all of my money, with being as healthy as I can be, having, my children be, well established. You're looking at a whole picture. And so you need to make all of the pieces that you've put together, your retirement planning, your savings plan, your health insurance, your car, your home, all of these things all come together to create your life plan. So Jan, one of her services is to help you think about, okay, what's my next move when I get to a certain point? How do I get there? And who do I talk to? Well, Jan's a specialist in this. She has not been doing this for a month. She's been doing this for years and years. She is an expert. So I would always tell people, get recommendations, talk to people, find out how long somebody has been doing something, what their expertise is. And if you're not 100% sure, if you have just an inkling of uncomfortableness, you have that gut feeling, then get a second opinion. You don't just have to sign up for something. This is not about, ooh, come in here, let me fill out an application, let's get you in there. It can't be that way. It's all got to work within your plan. So working with a financial planner, working with a realtor, working with an insurance broker, when you work an attorney, an estate attorney, when you all work together as a team, your team, the team that you put together, because it's your life, it's your plan, it's not mine. I have my team, and trust me, my team works, and my team works really hard because I have goals for my children, for myself, that I have been working for all of my life. I need a team. I know a slice of my own pie. So I go to the experts for the rest of it. My accountant, my estate attorney, my financial planner, my realtor, all of those things, my mortgage person, all of those people are experts in their field, and I pull them together as my team. So, Jan, do you have anything to add to that?
No, I wholeheartedly agree with everything you said. And all these professionals do work hand in hand to give a more holistic approach to serving our clients. And it's so important to have that. It's about much more than just the transaction. So everyone working together in your best interest makes a huge difference.
Right.
Absolutely.
Thank you. Angelique, did I answer all of those pieces?
Yes, you did.
Okay. What else we got? You have a
Next
few
one
more
is
minutes?
how many activities of daily living that you need help with are required before your long-term care insurance policy kicks in?
So it's when you can't do two of the six. So let me remind you what the six are. Okay. A, ambulation. That's one. Two, bathing. B. Three, cleaning. C. D, dressing. 4. E, eating. 5. And 6, feeling in control of your bladder and bowel is 6, or F. Okay, so two of those things. So if you can't bathroom yourself and clean yourself, those would be two things. If you cannot dress yourself, or if you cannot feed yourself, if you cannot get up on your own, or if you cannot walk and you need to be in a wheelchair, that would be A, or ambulation. You have trouble ambulating. So usually when you have trouble ambulating, Bathing is also quite possibly an issue. Now, those might be those two things that you need help with. It depends. So, two of the six that you cannot do starts the process.
Well, it's that time. It's 11 o'clock, and there were just two more questions, but I
Okay.
want to be mindful of everyone's time today. Um, it's up to you if you want to answer this question, Ellen.
Happy to go for it. If anybody wants to jump off because they need
Yeah.
to, completely understand. If you want to stay and listen to me chat some more, I'm happy to have you stay.
Well, then I'll lump them because they're kind
Okay.
of the same. So one is asking, saying they've heard of people speak of how they've had to fight to get their benefits. What's your experience? And then are there any options for people when their premiums go up tremendously, like double?
Actually, those are two very different. So let me jump on the first one. So, um, do you have to fight to get your policy paid? Unfortunately, sometimes it depends on how that policy is written. I have heard the best stories and horror stories. There are policies out there that are very difficult to have paid only because of their process. And it is a process. So if you follow the process and you put that new team, and that new team becomes the doctor who has to fill out all of the documentation, the insurance company's nurse or doctor that comes in to verify and to review the medical records. If you put all of those things in order and make it easier for the insurance carrier, and then you find out who your case manager is, and you work with that case manager and you follow the steps. They're not your steps, they're their steps. And to give you a very quick idea, so I help process my mother-in-law's claims every month. I have to follow the insurance carrier's process. It is not what I would do. And I will tell you, in the first couple of months, and I even know what I'm doing, there were one or two blips, but then we started working together and I knew exactly what they wanted and I followed their rules. I followed how they wanted things, how they wanted what documents, on what day. And so in my calendar, on that particular day, every single month, there is a note to myself to submit the claim that day so it gets paid that month. I follow their rules. It's just that simple. Again, it's about being organized. There was also another question, Angelique, earlier. Do I charge for helping? No, I don't.
Yes.
But I always tell people when they come to me, if they already have a policy in place, the first thing I will ask them is, have you spoken to the person who wrote your policy originally? And if you haven't, why? Why have they not reached out to you? Why have they not talked to you? Why aren't you speaking to your insurance broker? Minimum every year. Why? Life changes. It's my tagline, life changes. We're here to help you prepare for it because life does change in an instant. So call that person. And if they're not there and you need some assistance, you know what? I can at least talk a little bit. I may not know your specific situation. I might have to look at your policy. I can't do it off the top. Then the other question that you had, Angelique, was what was the second one? I'm so sorry.
The second one was what options do people have when their premiums go up
Ah,
tremendously?
fabulous. Okay. So if you, and I know everybody's been getting increases, especially if you have a Genworth policy. You have probably over the last several years gotten notifications. You're about to have an increase, and you can have these four options. Interestingly enough, when you look at those options, some of them may appeal to you. So I'll take a true example, actually. So here is somebody whose policy premiums went up. They get the notification. There are 5 options. They can do what's called a fully paid up. You never have to pay anything else. And they've paid, I'll use round numbers because I don't have the policy in front of me. They've paid $18,000 total into that plan since it started. That means that $18,000 is all the long-term care insurance policy will pay out. You need to read these very clearly because that looks, oh, I can have a paid up policy. I don't have to pay another thing, but it's based on what you've already put in. Then there are the ones where it says, change your waiting period from 90 days to 180 days. That's great. If you have the money to fund yourself for the first 6 months, and that will save you a substantive, not a little bit, but a substantive amount of money, then that's a good thing. Changing the term period of 6 years to 5 years or 4 years, or to take some of the money that's in the pot of money away or lower what's called your COLA, your cost of living adjustment, from 5% compound to 1% simple. Those are all things that are considered. And I tell everybody, before you make a choice, understand what those choices are. Talk to somebody, either the person who wrote the policy, or find somebody who is certified and knowledgeable to talk about them. The other thing that can be done, one last thing, is that none of those options may be viable for you. That's okay. New options can actually be created. Your insurance broker can actually go back to that carrier and say, hey, we need to tweak this a little bit. What if we did X, Y, and Z instead of A, B, and C to get to this point? And the other thing is, if it doesn't materially change your life and you know that you will need this care, it's another option to keep paying those premiums, even though they have gone up. So,
Well,
all right, we went over.
yeah, thank you so much. I want to say thank you for everyone who attended. Special thanks to you, Ellen and Jan, for sharing your time and expertise and enlightening our audience about how, with thorough preparation, we can face life's unpredictabilities. So again, thank you. I hope everybody has a wonderful time. And Ellen, thank you for staying after and answering those questions. If you have any more questions, I put Ellen's information in the chat, her email address, and then the link to her website. And so if you have any additional questions, you can reach her that way. And I just wanted to say too that we've got wonderful upcoming programs. I put the link in the chat. So please visit us and register today. And everybody have a wonderful, wonderful day.
Thank you so much, Angelique, Jan. Thank you, everybody. Appreciate your time today.
Bye-bye.
Bye.
Bye-bye.